Welcome to XRP Pro Ledger. And today we have one of those rare sessions where multiple massive narratives are colliding at exactly the same moment. And the way you interpret that collision is going to determine whether you make one of the best decisions of your investing life or one of the most expensive mistakes. While the broader DeFi space is reeling from a $10 billion exploit that just ripped through Ethereum-based protocols and sent shockwaves of panic across the entire crypto ecosystem, Wrapped XRP has officially gone live on Solana through Hex Trust and LayerZero. And the timing of those two events happening simultaneously is not a coincidence. It is a contrast that tells you everything you need to know about where the institutional smart money is going to flow next. XRP is consolidating right now at $1.41 to $1.42, down less than 1.3% on the session, with $2.5 billion in 24-hour volume and an $87 billion market cap holding the number 4 spot globally. The whales are not panicking. They are loading up, and this video is going to tell you exactly why. Let us start with a $10 billion DeFi exploit, because you cannot understand why today's XRP developments matter so much without first understanding the scale of the damage that just happened to the broader decentralized finance ecosystem and what it means for institutional confidence in smart contract-based DeFi. A $10 billion exploit tearing through Ethereum-based DeFi protocols is not just a bad news story for the specific platforms that got hit. It is a systemic credibility crisis for the entire model of complex layered smart contract architecture that the majority of DeFi applications are built on. When $10 billion in total value gets drained from protocols in a single exploit event, every institutional allocator, every risk manager, every compliance officer at every major bank and asset management firm that was evaluating DeFi exposure just had their worst fears confirmed in the most dramatic way possible. The risk that they were told was theoretical just became catastrophically real, and the institutional DeFi pipeline that was building quietly just hit a wall of fear that is going to take significant time and significant proof to overcome. Here is the critical distinction that separates XRP's situation from everything else that just got caught in the blast radius of this $10 billion event. And this is the distinction that the whales accumulating at $1.41 to $1.42 right now have clearly already made in their own analysis. The XRP ledger's approach to DeFi functionality, specifically the native lending protocol being built through XLS66, does not use the complex, layered, attack surface-rich smart contract architecture that just got exploited for $10 billion. The XRPL's design philosophy is fundamentally different. Instead of allowing arbitrary smart contract code to be deployed on top of the base layer, where each new contract introduces new attack vectors and new exploit possibilities, the XRP ledger builds financial functionality directly into the protocol layer itself, where it is governed by the same consensus mechanisms that secure the entire ledger. That architectural difference is not a minor technical detail. In the context of a $10 billion exploit, it is the single most important distinction in all of DeFi right now. Now let us talk about the breaking news that is the single most significant positive development in XRP's cross-chain story, because this one has been building for weeks, and today it officially went live. Wrapped XRP is now available on the Solana blockchain through the combined infrastructure of Hex Trust, one of the most reputable, regulated institutional digital asset custodians in the world, and LayerZero, the battle-tested cross-chain interoperability protocol that has processed billions of dollars in cross-chain transactions. This is not a testnet deployment. This is not a beta. This is a production-ready, institutionally backed, live deployment of wXRP on one of the most active and highest throughput blockchains in existence. And the timing of this going live on the exact same day that the broader DeFi ecosystem is hemorrhaging confidence following a $10 billion exploit could not be more perfectly positioned to capture the institutional attention that is now desperately looking for a safer alternative to what just burned them. The practical implications of wXRP being live on Solana through Hex Trust and LayerZero deserve a detailed breakdown because most of the market is treating this as just another bridge announcement when it is actually something significantly more structural than that. Solana hosts one of the most active decentralized finance ecosystems in the entire blockchain space, with hundreds of protocols, lending markets, liquidity pools, automated market makers, and trading applications generating billions of dollars in daily activity. Every single one of those protocols can now include wXRP as a native asset, as collateral in lending markets, as a trading pair on decentralized exchanges, as a yield-generating asset in liquidity pools. XRP's utility just expanded from the XRP ledger and its own ecosystem into the full breadth and depth of Solana's DeFi infrastructure in a single flip-the-switch moment. The addressable market for XRP just grew by billions of dollars in a single day, and the $2.5 billion in 24-hour volume sitting behind the 1.41 consolidation reflects the institutional awareness that this expansion is real and significant. The spot XRP ETF market crossing $1 billion in total assets under management is a milestone that deserves to sit alongside the wXRP Solana launch as a co-equal institutional signal, because the two developments together paint a picture of XRP being pulled simultaneously into two completely different pools of institutional capital. The ETF crossing $1 billion in AUM means that the traditional finance world, the registered investment advisors, the brokerage platforms, the retirement account allocators, has committed over $1 billion to XRP exposure through regulated, familiar financial products. That capital is sticky, it is patient, and it grows through systematic inflows rather than speculative surges. Meanwhile, the wXRP Solana launch is pulling XRP into the on-chain DeFi capital pool, the yield-seeking, liquidity-providing, protocol-native capital that drives organic on-chain demand. Having both of those pipelines filling simultaneously means that XRP's demand is being built from two completely different directions at the same time, which is an unusual and powerful structural position for any asset to be in. Now, I need to address something directly because there is a narrative circulating in certain corners of the XRP community right now that is so detached from reality that ignoring it would be doing you a disservice. There is a rumor spreading that Donald Trump held a secret dinner meeting where a decision was made to revalue XRP to $10,000 per token in order to pay off the United States national debt. I am going to be completely straightforward with you about this because you deserve honesty rather than hype. This is not real. This is not based on any filing, any legislative text, any executive order, any credible source, or any verifiable fact. The United States government does not revalue private cryptocurrency tokens. The national debt is not structured in a way that any cryptocurrency revaluation could resolve. And no credible institutional analyst anywhere in the world is using this framework in their XRP thesis. The people spreading this story are either misinformed or deliberately manufacturing excitement to drive engagement. Do not make financial decisions based on it. Here is why the $10,000 revaluation rumor is not just false, but actually harmful to the XRP community's credibility, and why the real institutional case for XRP is both more realistic and more exciting than any manufactured conspiracy theory could ever be. When serious institutional allocators, the Goldman Sachs research teams, the Standard Chartered analysts, the BlackRock portfolio managers, evaluate a digital asset, they look at the credibility of its community and the quality of the information ecosystem around it. A community that circulates $10,000 government revaluation rumors signals to institutional analysts that the asset's supporter base is driven by fantasy rather than fundamentals, and that perception creates friction in the institutional adoption process. The real XRP story: $1 billion in ETF AUM, wXRP live on Solana, XRPL handling sovereign bond settlements for Kyobo Life Insurance, Goldman Sachs' disclosed positions is already extraordinary. It does not need fabrication, and fabrication actively undermines it. Let us talk about the DTCC development, because this is one of the most significant institutional infrastructure announcements in the tokenization space, and its implications for XRP are direct and substantial. The Depository Trust and Clearing Corporation, which processes the settlement of virtually all securities transactions in the United States and handles approximately $90 trillion in securities transactions annually, has announced that their tokenization initiative is moving to production. The DTCC is not a crypto-native company experimenting with blockchain. It is the foundational settlement infrastructure of the entire American capital market system, and its move toward tokenized settlement represents the most significant convergence of traditional finance and blockchain technology that has ever been attempted at scale. When settlement infrastructure at the scale of $90 trillion in annual transaction volume moves to tokenized rails, it needs a ledger that can handle institutional-grade security, instant finality, and regulatory compliance. The XRP ledger has been building toward exactly that specification for years. The Clarity Act dimension of what is happening right now in Washington deserves serious attention because the legislative timeline is tightening in ways that are directly relevant to the whale accumulation happening at the 1.41 to 1.42 level today. The Clarity Act, which would provide a comprehensive regulatory framework for digital assets in the United States, is creating a situation in the traditional banking sector where institutions that have been passively holding stablecoins and earning yield on those positions are now facing the prospect of that yield being disrupted by new regulatory requirements. That disruption is causing smart money to rotate from stablecoin yield positions into direct crypto asset allocations, specifically into assets like XRP that have clear institutional utility, established regulatory relationships, and the kind of real-world deployment track record that justifies a significant portfolio allocation. The banks that are panicking over stablecoin yield disruption are the same institutions that are simultaneously evaluating XRP as the replacement for the yield and utility they are about to lose. And the whales accumulating at $1.41 today are positioning ahead of that rotation. The technical picture at the current 141 to 142 consolidation level needs to be understood in the context of everything that is building fundamentally. Because the chart does not tell the whole story, but it does confirm the thesis. XRP recently touched a high near $1.50 before pulling back to the current consolidation zone, with support sitting at $1.38 to $1.40 and resistance at $1.45 to $1.50. The fact that XRP is holding above the $1.40 support level with $2.5 billion in daily volume during a session where the broader DeFi ecosystem is in panic mode following a $10 billion exploit tells you something very important about the underlying bid structure in this market. When the macro environment is negative and the DeFi sector is in crisis mode, an asset that holds its support level with massive volume is demonstrating institutional sponsorship, meaning that large, well-capitalized buyers are absorbing every wave of retail selling and preventing the price from breaking down through support. That is exactly the pattern you see in assets that are being accumulated by smart money ahead of a major catalyst. The PNC Bank development adds another layer to the institutional picture that connects directly to XRP's core value proposition as the settlement layer for cross-border financial transactions. PNC Bank going live on Ripple's infrastructure represents a major American commercial bank making an active, production-level commitment to XRP-based payment rails rather than simply evaluating the technology in a sandbox environment. PNC is not a crypto-native institution experimenting on the margins. It is a top 10 American bank with hundreds of billions in assets and millions of business and consumer customers who use its cross-border payment services. When that bank goes live on Ripple's infrastructure, every cross-border transaction it processes becomes a real-world validation of XRP's utility at commercial banking scale. And every competing bank watching that deployment begins its own internal evaluation of whether it can afford to let PNC have a cost and speed advantage in cross-border payments without responding. Institutional adoption in banking does not happen in isolation. It creates competitive pressure that accelerates the adoption curve. Let us now synthesize everything that has happened today into a unified thesis, because the individual developments are significant on their own, but the convergence of all of them simultaneously is what makes this moment genuinely historic for XRP holders who are paying attention. The $10 billion DeFi exploit just destroyed institutional confidence in complex smart contract DeFi and sent risk managers looking for a safer alternative. On the exact same day, wXRP went live on Solana through institutional-grade infrastructure, offering XRP's exposure to DeFi liquidity without the smart contract exploit risk that just cost the industry $10 billion. XRP ETFs crossed 1 billion AUM, proving that traditional finance capital is flowing in through regulated products. The DTCC announced $90 trillion in tokenization, moving to production on infrastructure that aligns with XRPL's architecture. PNC Bank went live on Ripple's payment rails. The Clarity Act is rotating institutional capital from stablecoin yields into direct crypto allocations. And through all of this, XRP is holding at $1.41, with $2.5 billion in volume, while whales accumulate at every retail panic dip. The position you are in right now, as someone watching this video with all of this context fully assembled, is fundamentally different from the position of the retail investor who is looking at XRP's 0.8 to 1.3% daily decline and concluding that it is a bad day for XRP. You know that the $10 billion DeFi hack is not a threat to XRP. It is a catalyst that redirects institutional DeFi interest towards safer architectures. You know that wXRP going live on Solana just expanded XRP's utility into a multi-billion-dollar DeFi ecosystem in a single day. You know that ETF AUM crossing $1 billion represents sticky, systematic institutional capital building a demand floor under the price. You know that the DTCC, PNC Bank, Kyobo Life Insurance, and Goldman Sachs are all moving toward XRP infrastructure simultaneously. And you know that the whales sitting at 141 buying everything retail is throwing at them have done the same analysis you just did and reached the same conclusion. The consolidation is the opportunity, and the opportunity is closing. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.